these various levels over the period of time since this is from the mid-1990s. And it's, you can see in the bottom half of the graph, I mean this is just the stock market up here, but the bottom half of the graph is the sentiment. And obviously it's something, this is a Ned Davis graph again, there are an awful lot of investor sentiment measures. This is, I think, one of the better ones, but you can just see from the frenetic movement of the line, it's something that is fairly quick moving, that sentiment moves back and forth fairly aggressively. And when you look at this box, you can see, first of all, that your best gains come when investors are pessimistic, and especially when they're pessimistic and they're starting to get a little bit less pessimistic, a little more optimistic. Conversely, you get your worst results when people are just gangbusters. You know, this place has got it's got nothing to do but go up. You know, and that tends to be when the markets go down. Now, the interesting thing is when you look at something like this, and when you look at this performance box, you'd say, well, why wouldn't you just always follow this and be on the right side of the market? Seems pretty simple. Seems pretty simple. Let me show you a couple of... First of all, it's a very fast-moving index. So if you were a really adroit, active trader, you could probably make money on most of the moves. Not all, by any means. There's no perfect index, but many of the moves. But let me point out a few things where, first of all, this works better on the buy side in bull markets. Now, that seems a little simplistic, but you're going to get better results when you buy these sentiment bottoms down here when the market is rising overall, not just in that short time period after this. Conversely, you can lose an awful lot of money buying some of these bottoms when the market is really tanking. And I give you an example. I mean, you made money on all these, anything down in here. You bought any of those bottoms, or even you didn't have to buy the bottom. You just go somewhere that you made money because the market was going up all the time. If, on the other hand, once you started down here, and I can't line this up precisely, but you start buying some of these lows even, you better get out really quickly if you want to keep your money on the table. You carry it just a little bit too far, and you're doing some of these things. A couple of these gave you 30% losses if you bought those bottoms. So it's not at all easy. A lot of people, and of course then again was good to buy the bottoms in here in that time period, but then we got 07, 08, 09 and so on, and a lot of people say, well gosh, I mean sentiment was so awful. Of course you could have bought that. It's a piece of cake. Well, sentiment was awful back in here. That was up here. And then it was really awful when it got down to here. I mean, that was really, really bad. And then again, one of these. By the time you got to the final bottom here, if you had been buying bottoms in sentiment all the way along, even if you knew they were the bottom, and of course you don't know they're the bottom when they show up, you only know it's the bottom after you see it's gone up after that. But even if you picked every one of them, you lost money unless you got out real quickly on the very brief rise that came after that. So after a year of being wrong, buying every bottom, now in retrospect we know it would have been brilliant to buy that one. It would have been brilliant. You've lost for a full year buying those bottoms. How strong is your risk-taking gut? How strong is it at that point? It's tough to do. Remember back then, when the sentiment was absolutely troughing, there was talk that the system might not survive. We lost Lehman. We didn't know that what the Fed and the Treasury and so on ultimately did was going to work. 2 weeks before they implemented the final plan, they said they were going to do something different. They were going to do something different. They changed in a 2-week period. They didn't just suddenly get brilliant. They were doing the best they could. They were trying to throw money at the problem in a way they thought would be most effective. It did. It worked. They saved most all the banks. Sorry, Lehman. But you can't have everything. And of course, then they fed them free money for years, and You let them borrow at zero and make the spread, and then fortunately they were able to pay some good bonuses, so at least New York collected some taxes. That was important. You wonder why Occupy Wall Street people are a little concerned. And quick aside on that, because I tend to pay a lot of attention to social mood, I think this is meaningful. I think that it's more than a short-term protest. And I would not be surprised if we start to see levels of violence in this country. That would not surprise me at all. That would be a very tragic outcome. I pray that we don't see something like that. But it would not surprise me in the least. I think we hear politicians talking about class warfare. I think we're going to see class warfare, not just on taxes. I think we're going to see real antagonism among peoples. And if we don't solve the unemployment problem soon, and I don't know that there is an easy solution, I don't think there is, we're going to see a lot of disenfranchised people very, very angry, and it would not surprise me that it would end up in violence. So that would be a very, very sad episode in our country if something like that happens. But I think the fact that we're seeing this sort of thing around the world, for obviously very, very different reasons in many countries, people get ideas. Sometimes they even get very crazy ideas just by seeing other people do them. Well, that's not unknown to any of us in almost any area. And of course, with the media carrying pictures vivid as life from everywhere in the world, it really does set things up where we have that potential of seeing other people do something. We say, well, gosh, it worked over there. Maybe we do it here. You hope not, but we'll see. In any case, point here is this is a good guide. It's by no means an infallible guide, and it's by no means an easy guide. Let me do just a quick summary of the equity outlook here. I believe we entered a cyclical bear market at the May high. And I think we continue in what many of you who have been coming to these seminars since the end of the 1990s know that I said at the end of the 90s, we were about to go into a long, weak cycle in the stock market. The two main reasons were excess debt and excessive stock valuations. And in the period between 2000 and today, we have partially worked off the excessive valuations. Price to earnings is now slightly below average. That's not bad. The other price twos are not terribly attractive yet. Price to sales is okay, but price to book value, price to dividends, price to cash flow are all very, very high on a historic basis. So we're not out of the woods on valuation, but we're a heck of a lot better than we were at the end of the 90s and around 2000. Unfortunately, the second of those problems, which is excessive debt, is a heck of a lot worse today than it was in year 2000. And it's going to continue to get worse. We're not even making any plans to try to bring the number down. We're just trying to control the growth of the number. I mean, this super committee is supposed to come up with 1.2 trillion or 1.3 trillion in cuts, or 1.4 trillion, whatever the number is, to be spread over 9 or 10 years or something like that. We have a $1.3 trillion deficit now, this year. It's going to keep growing. And we're playing with small amounts. It may work. Maybe we'll find an answer, and the biggest threat to this is that the people to whom we owe money, prime of which are China, Japan, Great Britain, in a sense, call the loan. I don't mean actually call it. They could just stop buying. If they get ticked off enough, and of course here we are right now in a very contentious position with China. We're trying to brand them currency manipulators. And, you may well agree that maybe they're currency manipulators. Of course, it's hard to say we're not currency manipulators. And it depends how you look at it. But we may pass something in the Senate that says they are currency manipulators. They've threatened they might start a trade war. That happens. That then you get very protectionistic. And of course, we're hearing a lot of protectionist sentiment now. When people are unemployed, when people are afraid about being unemployed, protectionism is the natural first response. Help me. You know, stop these evil people sending this cheap stuff in where I'm making it with my own hands. It's not, we got a lot of problems here. In any case, I think we're still in the long week cycle that began year 2000. I said at the time, over the past 2 centuries, the average long cycle has lasted about a decade and a half. Some longer, some shorter, decade and a half is an average. The long, strong cycle that we came out of covered essentially the decades of the 80s and 90s. It built up more excesses than any other of the long, strong cycles in the last 200 years. The logic then is that the expunging long week cycle will either take longer or will be more violent in terms of erasing the excesses. We've partially done it, but we've exacerbated one of the 2 problems, the excess of debt. How we're going to come out of that is a great unknown, a great unknown. If we look at the economy right now, corporate earnings are still very good. That's surprised a lot of people that corporations have been able to make as much money as they have made and continue to do that. Now, that CEO survey would say that probably earnings are coming down, but we haven't seen it yet. We've seen the growth in earnings come down some, and that might continue. It certainly will continue if we go into recession. There we'll see earnings come down, but we don't know that we'll go into recession yet. That's an open question, although the tendency is in that direction right now. Europe is either in or on the verge of a recession. Government may or may not succeed in bailing out the Eurozone and its banks. It doesn't take a genius to know that there's a tremendous risk still in the outcome of the whole European situation. The emerging market economies are slowing, and I think at this time there are significant questions about whether China is on the cusp of a real estate and or banking crisis. Very good analysts have said China can do all it needs to support its banking system, and that might be correct. I've heard very conflicting stories about the real estate problem. There are some very reputable people saying there are just rows and rows of empty buildings and all kinds of real estate in China that's been badly overbuilt, and the loans that went into all of that are going to be very difficult to service. That may or may not be true. I mean, obviously the info out of China is not quite as accurate or as precise as perhaps the info that we get out of Europe and out of the United States. In this country, we're increasingly relying on the Federal Reserve to bail us out from weak fundamentals. I think fairly clearly they're running out of ammunition. Bullard says we never run out of ammunition. We can always do more. Of course, they can always print, but the arbiter, technically they can't print, but they can effectively print. The ultimate arbiter is the bondholder and the bond buyer. And if they go on strike, no matter, they can print all they want. We're probably going to see interest rates go sky high very quickly if we get to that get to that point. You can argue, well, there's a mutual, it's almost mutual assured destruction if China or somebody else chose to start selling back bonds because it would hurt them terribly. Certainly it would. But would they do it for political reasons? Would they do it as a shot across the bow if we designated them as a currency manipulator? I don't know. I mean, somebody in here, expert in the Chinese government, maybe they could fill us in. I don't know. The answer is we don't know, but that poses great risks to people who have to make investment decisions. Short-term notwithstanding, I think most stock prices in the ultimate evolution of the long week cycle will probably end up lower. For reasons we were pointing out earlier, we may well need to see further bounce up higher to get rid of some of the negative sentiment.